Truworths incorporates the Truworths Man, YDE Identity and Daniel Hechter brands. It has a market cap of 38 billion rand, a price to earnings ratio of 15.4, dividend yield here of nearly 5%. Can we go wrong with this story, given the general undertone where the clothing retailers are concerned?
Yes, I mean, if you look at the PE ratio on a fundamental basis, it's by far the cheapest of all the stocks we're talking about, but I think for good reason. The earnings growth is a lot slower. I think they've battled a bit with their product mix and their target market. I think their pricing hasn't been great. And this is just on personal opinion, walking into a Truworths and seeing what they have to offer. But I think, we could see a bit of a turnaround and maybe, a cheaper entry into the market.
Chris, would you discount this one as the laggard of the sector?
Byron's absolutely spot on, Bronwyn. It is the laggard, and I think for a very good reason, and he's espoused most of those reasons. There's another reason, though, and that is it's almost as if Truworths was targeted by the likes of Zara, Cotton On, and many of those other foreign retailers that come into the country, because these guys have really taken the biggest hit from all of those. I mean, look, it's a great company. It's very, very well managed. We're seeing a bit of succession taking place now. Michael Mark handing over to this French guy. Is it going to work necessarily? Not entirely sure. I think maybe a company like this 15 years ago, this was the benchmark. This was the yardstick by which all other clothing retailers were measured. Not anymore.
And look at it there in 2013, Byron, tracking really well from a share price perspective. And now what? Lingering around that 90 Rand level?
That big period of underperformance, I think. A lot of concern about the size of their credit book. I think it's about 5.5 billion rand. I mean, that's during the whole African bank debacle, and everyone wants to step far away from credit. But they've managed that fairly well. In their latest results, they said about 86% of their current card holders were able to carry on purchasing, which means they're in a decent financial position. So about 14% would go to a Truworths and be denied. I think,
So have they cleaned up their book appropriately?
I think everyone has had to be a lot more cautious. But of course, selling on credit is a great business because you're selling, you're getting your instant margin, and then of course you're charging interest on top of that. So in essence, you're selling it for more than what's on the price sticker. But I think Mr. Price and the cash boards of the world have proven that cash is probably a better place to be at this stage, and that's probably why Truworths has that big discount.
Chris, let's get your thoughts.
Yep, I think all the bad news is discounted, but I think the bad news is going to continue for a while yet. So I wouldn't be. I'm not hot on this one.
And it's still on that credit element. That's where we've got to be cautious.
And the fact that it seems to be taking most of the brunt of the competition from the overseas retailers.
So not hot from you.
Yeah,
Byron?
I always feel they're a couple of years behind. You walk into a Truworths and it's Mr. Price 2 years ago. So I'm not going to be hot on that.
Not hot.